Hello everyone, welcome back to Stock Spy. Today's mission takes us inside the fast-growing caffeine empire, Dutch Bros, ticker PROS. The company has built a cult-like following and rapid store growth. But can the stock deliver for investors? Or is it just another sugary rush? Let's decode the truth. So, founded in 1992 in Oregon by two brothers, Dutch Bros have evolved from a single push cart into a 900-store drive-through powerhouse across 16 states in the US. Unlike Starbucks' premium coffee house feel, Dutch Bros thrive on speed, friendliness, and youthful energy drinks. Their drinks like the Golden Eagle Latte, Rebel Energy lines appeal to the Gen Z customers who want flavor and fun. The strong community vibe has turned customers into loyal fans. Now let's look at the numbers. The company continues expanding aggressively. In its latest quarter, the revenue climbed about 25% year over year to roughly 300 million. Management aims to open 150 new shops in 2025 and eventually reach 4,000 nationwide. But profits, they are still missing. Dutch Bros remain net loss-making, with rising labor and ingredient costs which are squeezing the margins. Adjusted EBITDA is positive, but true earnings are elusive. In short, growth is impressive, but profitability not quite there yet. Now, what's smart money doing here? Institutional investors, the likes of Vanguard, BlackRock and all, collectively hold about 60% of Dutch Bros shares. That level of ownership shows confidence in long-term story. However, there has been little new institutional buying recently. Funds are mostly holding and not adding, a signal that big players want to see margin improvement before doubling down. So while the base support is strong, conviction hasn't fully returned. Institutions are sipping, not chugging. So let's look at the key risks. They are facing three main challenges. One is the margin pressure. Wages, milk and coffee prices keep getting higher. Then there is this execution risk. Rapid expansion can dilute culture or overextend capital. Not to mention the competition. Starbucks, Dunkin', regional chains are all targeting similar markets. The company's heavy investment in growth means cash flow will remain thin for a while, especially if consumer spending softens. Now the bull case, the optimist who sees the big upside. They have a passionate fan base built on its friendly culture. An efficient drive-through model with low setup costs and quick services. A long runway, fewer than 1,000 stores compared to Starbucks' 16,000 in the US alone. If the mainstay strong same-store sales and slowly improves margins, they could eventually join the ranks of successful growth chains like Chipotle or Wingstop. So, what am I going to do here? Dutch Bros is a compelling long-term story, but right now it's priced for perfection at around 4x sales, and it's still unprofitable. The growth narrative is real, but fundamentals are quite brute to perfection. Institutional investors are holding steady, and that's my play too. I wouldn't buy today. I'd wait for one of the two signals. One is the stock dips closer to $20. Or management shows clear progress towards consistent profits. Until then, they would stay on my watch list, but not on my portfolio. So that concludes a short video on Dutch Bros stocks here. A caffeine-charged growth story with long-term potential, but still in its testing phases. So if you enjoyed, hit the like and subscribe buttons. And thanks a lot for watching.